Hello everyone, my name is Farhan. Today here we have a question from 2016 paper 2 past exam. This is question number 1 and the requirement in this question is to prepare the income statement, which is now known as the statement of financial performance, and the balance sheet, which is now known as the statement of financial position. You will see the question on the left hand side of your screen, and on the right hand side you'll see all the workings, which I'll go through step by step. So with that being said, let's begin. The following balances were extracted from the books of Usman Limited on 31 July 2016. So we're working with a business where the most recent financial year just ended on 31 July 2016. And based on the word limited, we can understand that we're working with a business which is a public limited company. We are given all the information that we need within this table, and underneath this table you can see that we're provided with additional information for adjusting purposes at the end of the financial year, which is 31 July 2016. So the requirement in part A is to prepare the income statement for the year ended 31 July 2016, and then we will prepare the balance sheet at 31 July 2016. So let's look into the workings on the right hand side. And we're going to do this by first looking into the additional information that we are given. What does the first information say? General expenses of $350 were prepaid and $560 were accrued. All right. So general expense is an expense in itself, and we have got a prepaid general expense. So when we say that we have got a prepaid general expense, we are referring to an expense which we have paid in advance. All right. And this expense which we have paid in advance has not been used yet in the current financial year ending 31 July 2016. Therefore, because it's a prepaid expense, it is a current asset. When we think about current asset, we think about economic benefits that we expect to get within the next 12 months. So if we had paid expenses in advance, which we still haven't used yet, we have some economic benefit which we can consume in the next financial year after 31 July 2016. All right. So prepaid general expense in this case is a current asset. And the reason this is a current asset is because we have made the payment in advance, but we still haven't utilized the benefit that comes with this expense. Okay. We also have an accrued general expense, which is also known as the general expense that is owing, and this is a current liability. The reason this is a current liability is because this is a present obligation for the business. And when I say it's a present obligation, it means that we have taken the benefits, we have incurred this expense, but we still haven't paid this expense yet. All right. So we have used the benefits that comes with this expense, but we still haven't used this expense, which means payment is owing. All right. So expense has been incurred and the payment has not been made. And that is why this falls under the definition or category of a current liability. And therefore, we call it an accrued general expense or general expense owing. Now, what's the treatment with regards to the income statement and the balance sheet? Now, in the income statement, we calculate the profit using the matching theory, which says that profit is calculated by taking all the revenues that we have earned and deducting or subtracting all the expenses that we have incurred. Okay? So all the expenses that we have incurred, which means all the expenses that we have actually utilized in the current financial year ending 31 July 2016. So in the income statement, when we report the total expenses, the total general expenses to be specific, we are going to do some adjustments. And what are those adjustments? Let's go to the table. So in the table, you will see that we're given general expenses of 39,700. All right. So this 39,700 is also including the prepayment that we have made on general expenses, but excluding the amount that we owe for general expenses. Okay, so the adjustment that we have to make here within the income statement when reporting the total general expense is we start with the 39,700, which is given to us here in the table, all right? And then subtracting 350 in prepaid general expense because we haven't used this expense in the current period. So therefore, if you want to calculate an accurate profit, we need to make sure it is deducted, okay? Because this is prepaid. And then we are adding 560, which is the accrued general expense or the general expense owing. And the reason we are adding is because we have used the benefits from this general expense in the current financial year ending 31 July 2016, right? But we still haven't paid it yet. So the total general expense in this case is 39,700, which is taken from the table, minus 350 to remove the prepaid general expense, plus an additional 560, which is to add the accrued or the general expense owing. And that gives us a revised figure for total general expense of 39,910, which is what we will report in the income statement. Okay? Now, do not forget that when you are preparing the balance sheet, you have the current assets, right? So under the current assets, you're going to report the prepaid general expense of 350, and under the current liabilities section, you're going to report general expenses owing of 560, all right? Okay, so let's move to the second additional information that we have got. Interest on the bank deposit had not been fully received, all right? So you see, I have highlighted the word received. And the reason I have highlighted the word received is because this is referring to an investment. And you need to be careful when you are doing similar stuff in the exam because it could be interest income or it could be an interest expense. And that is dependent on whether it's a liability or it's an investment. Now, how do I know it's an investment? All right. So in the table, you're given the 10% bank deposit short term of $15,000. Okay. Now the 10% here refers to the interest rate. Okay. And the short term here refers to an investment that is made for perhaps 1 year. So based on the additional information number 2, interest on the bank deposit had not been fully received. Okay. Had not been fully received. And the reason it is an investment is because of this last word, full receipt, which is pointing towards the fact that we expect to earn some interest from this investment, which is interest income. Okay. Now, so I have highlighted here that it's bank deposit. We have made an investment. So bank deposit is you went to the bank and you deposited some extra cash that you had. And on that extra cash that you had deposited in the bank account, you're getting some interest income, okay? And that interest income is derived or calculated at the rate of 10% per annum. All right, so interest income per annum is 10% multiplied with $15,000, which is the original amount of investment that we have made. And that gives us an annual interest income of $1,500, okay? So this entire amount of $1,500 is to be reported as interest income when you prepare the income statement or the statement of financial performance. Okay? All right. Then let's check the information that we have got underneath the bank deposit, which says that interest received on bank deposit is $1,000. Okay? All right. So what do we understand by that? Interest received of $1,000 simply refers to the cash that you have got, which is $1,000. But you know the total amount in interest that you can earn during the whole year is $1,500, which we have calculated by multiplying 10% on our investment amount of $15,000, right? Okay. So if the interest that we have received for cash is $1,000, and the interest income based on our calculations is $1,500, this means that we still expect $500 of more in interest income, right? And that is what we refer to as interest receivable. So when we say interest receivable, from our perspective, we are expecting some additional interest income, and that is $500. And because it's an economic benefit that we expect to get in the future, mainly within the next 12 months, this is classified therefore as a current asset. Okay, so when you prepare the balance sheet, underneath the current assets section, you will report interest receivable of $500. Okay, all right. Now, let's move to additional information number 3. Okay. Machine repairs of $3,000 have been incorrectly debited to the plant and machinery account. All right. So when we read this, we understand that we have got an error, and that error is what we classify as an error of principle, which you will go through when you start studying for your exam eventually. So error of principle. So error of principle happens when the classes of treatment are different. So what do we mean by that? So you see, machine repairs in itself is an expense, but we made a mistake where we treated this expense as the purchase of a non-current asset. Expense in itself is one category, and then the purchase of a non-current asset in itself is another category. So we have got 2 different categories here. So when you make mistake within the categories where you recorded an expense as the purchase of a non-current asset, we have made an error of principle. Okay. Now, how do we fix this? So machine repairs, as we understand, it's an expense. So all expenses are reported in the income statement, right? So when you prepare the income statement and you want to show the total for machine repairs, you want to make sure the amount which you forgot to include as the machine repairs of 3,000 is added back with the amount that we are given in the table. So in the table, you're given machine repairs of $5,600, as you can see here. Okay. All right. But this amount excludes the $3,000, which we incorrectly debited as the purchase of a non-current asset. So what we're going to do when you prepare the income statement, the machine repairs is fixed by adding the $3,000 with the $5,600 that we got from the table, and we get $8,600 as the total machine repairs expense that we report in the income statement. Then in the balance sheet, when you show the plant and machinery at cost, all right, we're talking about the cost. What you need to make sure is you deduct the $3,000 that you mistakenly added before, right? That's what the additional information number 3 says. So the original plant and machinery at cost based on the table is $196,000, and now we are to subtract the $3,000 which we mistakenly included. Okay, so that's what we are doing here. So altogether, the plant and machinery at cost is to be reported at $193,000 when you prepare the balance sheet. Make sense? All right. So now let's move to additional information number 4. All right. So depreciation is to be charged as follows. So we have got the plant and machinery, which is depreciated at 20% per annum using the reducing balance method. And then we have got motor vehicles, which is depreciated at 25% per annum using the straight line method. All right. So let's start with the reducing balance method first. So under the reducing balance method, if you want to calculate depreciation, you need to first know the net book value. This is a must, okay? And how do we calculate the net book value? The net book value at any given point in time is calculated by taking the original cost and then subtracting the accumulated depreciation for that asset. So what do we understand by accumulated depreciation? Accumulated depreciation refers to the total depreciation. All right. Now, the cost of that asset, as we understand, is given as $196,000 here, all right? But we have made some correction, which we need to fix here. So I think when I did my workings before, I forgot to include that, but we'll fix that here. So the cost is 193,000, not 196,000. Do you know why? Because we have already made the fix by subtracting $3,000, which we incorrectly included before, right? Okay. So this is $193,000 now and not 196,000, which I made a mistake before. So I hope you get it. So then you subtract the accumulated depreciation of $68,000, which is what you can get here. Accumulated depreciation, plant and machinery of $68,000. All right. So once you subtract $68,000 from 193,000, how much do we get? So we should get something like 125,000. Okay. So we get $125,000 as the net book value for plant and machinery. Okay. And every time you are finding the depreciation using the reducing balance method, you must first calculate the net book value, which is always the original cost minus the accumulated depreciation. The original cost in this case is 193,000, not 196, because we had to remove the incorrect machine repairs that we included before, and that made it 193,000 as the correct amount of the correct cost. Then we are subtracting 68,000 in accumulated depreciation, and that gives us a net book value of 125,000. Now we want to find the depreciation, and you can find the depreciation by multiplying the given percentage with the net book value. The given percentage is 20 based on the question, as you can see here. I'm just circling that, right? 20%. So 20% multiplied with the net book value of 125,000. Okay, so let me just fix this. 20% multiplied with 125,000. How much should the depreciation be? It's going to be $25,000. All right. Okay. So 10% of 125,000 is 12,500. So 20% is going to be double of 12,500. So yeah, $25,000. That sounds correct. All right. So how do we treat this depreciation in our financial statements? So when you prepare the income statement, we need to show all the expenses that we've got, right? And depreciation is an expense in itself, which refers to the cost of the asset that we have consumed over its useful life. And in this year, we have consumed $25,000 worth of value. So therefore, we have some depreciation expense that we have incurred. So in the income statement, we show depreciation of plant and machinery of $25,000 underneath the assets, underneath the expenses section. Okay. And when you prepare the balance sheet, you see that we show the total for accumulated depreciation for the non-current assets. So what we're going to do, accumulated depreciation simply means all the depreciation that we've got so far, right? So originally from the table, we started with 68,000, right? 68,000. Then we add an additional 25,000. Okay, which makes it 93,000 as the accumulated depreciation that we will report in the balance sheet. Okay. All right. So now let's move to the straight line method. So the motor vehicles are depreciated at 25% per annum using the straight line method. So when you find the depreciation using the straight line method, it's pretty straightforward, where you multiply the given percentage with the original cost. The given percentage is 25. The original cost is given to us as 84,000, as you can see here, 84,000. Okay. All right. So 25% multiplied with the 84,000 original cost gives us a depreciation of $21,000, which is an expense, and that is to be reported in the income statement. And then you go to the balance sheet. You prepare the accumulated depreciation section. You start with the 32,000 that we originally had been provided in the table, and then you add the additional 21,000 which we have incurred in this financial year, ending 31 July 2016. Altogether, the accumulated depreciation comes out to $53,000, which is what we report in the balance sheet. All right. Okay. Let's move to the next one, which is number 5. Okay. It is estimated that a debt of $800 might not be collectible. All right? Might not be collectible. Okay. So you can check the allowance for impairment of trade receivables in the table that we were given, and you would say it's $600. Okay. So what do we understand by allowance for impairment of trade receivables? This is referring to the possible amount that our credit customers owe. So there's this possibility that $600 of the amount that we expect to get from our credit customers is we may not be able to collect that. Okay. So we may not be able to collect $600 from the credit customers. Okay. So this is what it's referring to. And this is based on mainly previous experience or historical data, based on what percentage of customers actually pay on time and what percentage of customers do not end up paying, right? Now, point number 5 says that the most recent estimate of allowance is $800, which we expect to not collect. It is estimated. The reason when it is an allowance is because it clearly mentions it is estimated. So it is estimated that a debt of $800 might not be collectible. Okay? All right. So there is an increase from 600 to 800. Okay? So if you want to find the increase in allowance for impairment of trade receivables, which is simply the difference between 800 and 600, it's 200. And this increase in allowance for impairment of trade receivables is what we classify as an impairment loss, okay? And this is to be reported in the income statement. So the impairment loss is here because now the possibility of getting the money from our credit customers have decreased based on the circumstances which we can see here. It was originally 600, which we thought that we may not be able to collect. Now it's 800, which we expect to not collect, right? So there is an increase of 200, which is what we refer to as an impairment loss, okay? So impairment loss is an expense. In fact, any losses that you have are classified as expenses, okay? And that's what we are reporting in the income statement. Now, when you prepare the balance sheet, all right, so here I have an extract for the current assets section. So when you prepare the balance sheet, you will show the trade receivables, who are also known as the credit customers of the business. So the gross amount or the original amount of trade receivables that we are given here is 18,500. Do you see? I'm just highlighting on the left-hand side. Yep. So we start with the original amount and then we subtract the allowance for impairment of trade receivables, the original amount that we have at the end of the current year based on the additional information, which is 800. Okay, so that is what you have to deduct, and whatever you get, which is 17,700, is the net trade receivables. Okay. All right, so just a quick recap before we move to point number 6. In the past, we had an allowance for impairment of trade receivables of 600, but based on the additional information given in point number 5, we now estimate this allowance to be 800. What do we understand by allowance for impairment of trade receivables? Allowance for impairment of trade receivables is an estimation of the money that we may not be able to collect from our credit customers, who are also known as the trade receivables. So this amount has gone up from 600 to 800. And when this amount goes up, we have an impairment loss, which is an expense and is to be reported in the income statement. Okay? And then when you prepare the balance sheet, the current assets section, you show the trade receivables, right? So you start with the original amount of trade receivables of 18,500, which we have taken from the table, all right? And then we subtract the allowance of 800, which we have for the current financial year, and that leaves us with a net trade receivables of 17,700. Okay? All right. So I think we have one more additional information. Okay, so point number 6, the company declared a dividend of $0.12 per share. The dividend will be paid on 31 October 2016. All right, so you can see that I have highlighted the words declared and 12 cents per share. And the reason I've highlighted the word declared is because declared means that it has been declared and not paid, okay? So we haven't paid it yet, which is again confirmed by the next line, which says that this dividend will be paid on 31 October 2016. All right. So because we still haven't paid it yet, but we have declared it, we have an obligation to our shareholders to pay this dividend. Dividends mean the share of profits, and share of profits are distributed to the shareholders or the investors of the business, right? So now that we have an obligation, which is to be repaid very soon within the next 12 months, we classify it as a current liability. So when you prepare the balance sheet, under the current liabilities section, you will show dividend declared, okay? And that amount is calculated as 12 cents per share or $0.12 per share. So how many shares have we got? We have got 100,000 ordinary shares, which you will find in the issued share capital line, 100,000 ordinary shares. So 0.12 multiplied by 100,000 gives us $12,000 as the dividend declared, which is to be reported under the current liability, okay? We also have to calculate the closing retained earnings. So what do we understand by retained earnings? It refers to the amount that's available for investment in the next financial year after the dividends have been given out to the shareholders. So we're not going to calculate this now. We will calculate this when we prepare our balance sheet. But for now, I'll just write a simple formula. So if you want to find the closing retained earnings, you start with the opening retained earnings, which is what you are given in the table. And then you will add the profit, which is what we will calculate from our income statement. And then we will subtract the dividends. All right. So we will be doing this when we prepare the balance sheet, okay? But for now, you can just stick to this formula. All right, so let's see how we can prepare the income statement. I already had an outline prepared in advance, so I'll just go through the numbers, okay? All right, so you can just add $2 here if you want. All right, so the first step of preparing an income statement is to start with the revenues, all right? So the way I like to do this type of questions is to tick everything that we have picked as we go, okay? That way you know for sure that you did not end up missing any important information which may cause the balance sheet to not balance, okay? And I suggest you stick to a similar methodology for full marks in the exam. All right. So the sales revenue is given as $325,000, okay, as you can see here. So I'm just going to tick with red because it implies that I have already utilized this number. So $325,000 is the sales revenue. Then we subtract the sales returns, which is right underneath the sales revenue of $2,400, okay? So once you subtract the sales returns from sales revenue, 325,000 minus 2,400. So I'll need a calculator. So 325,000, okay, minus 2,400. That's 322,600. Okay. So now that you have your net sales revenue, the next thing we subtract is the cost of goods sold or the cost of sales, which is given to us here of 94,300. Okay. All right, so we have already selected that. So once you subtract the cost of sales from the net sales revenue, we get gross profit. And the gross profit that we get is 228,300. Okay? All right. Then we add any other income. All right. So after the gross profit has been calculated, always add all the other income that we have. And the only other income that we've got in this case is the interest income. All right. Based on point number 2. If you recall, the interest income was 1,500. So I'm just going to scroll back up, or perhaps I'll just do the working here again. I don't want to break your focus. All right. So if I was to find the interest on the back deposit, the interest income, that would be 10%, right? So 10%, which is the interest rate that we expect to earn on the investment of 15,000. And altogether, it would be $1,500 worth of income, right? Yep. So plus interest income of 1,500, okay? All right, so I'll just add that number here as well. So which is 229,800 after the interest income is added to the gross profit. Okay. All right. So next we subtract all the expenses that we have got. And what I like to do is start from the top of the table. So from the top of the table, we are first given the plant and machinery at cost. We don't need that yet. We need that for the balance sheet. Yep. We have the accumulated depreciation, which reminds me that we need to include the depreciation of plant and machinery and the depreciation of motor vehicle. Okay, so depreciation of plant and machinery, how much is it? It was 25,000. Okay, how did we get 25,000? So I'm just going to remind you that after we had fixed the cost amount for the plant and machinery, it was 193,000. Okay, then we subtracted the accumulated depreciation of 68,000, which gave us the net book value of 125,000. Do you recall? I believe so. Then you multiply the given percentage of 20. Okay? And that's how we get 25,000. Okay. Next, we have the depreciation of motor vehicle, which we simply calculated by applying 25% on the cost of 84,000. And we did that because it's a straight line method. And that gave us $21,000. So I'm not going to scroll back up, like I said, to break your focus. So I believe you have taken note of all the workings that we have done earlier. So from that workings, you can recall the original numbers that we had derived. Okay? All right. Now, next we've got salaries and wages, which is right underneath the cost of sales. Okay? And that's 78,960. So 78,960 in salaries and wages. Okay, I'm just highlighting point number 4 because we have included depreciation already. Okay, and then we've got machine repairs, which is not 5,600, but actually 8,600 after the correction has been done. Do you recall? So we added an extra 3,000, which we forgot to add before. So machine repairs is 8,600. Then you've got general expenses. So general expenses, the original amount is given to us as 39,700 in the table, as you can see here, right? But we are subtracting 350 for prepaid and adding an 560 for accrued, right? Okay, so 39,700 minus 350 plus 560, which is 39,910 for general expenses. And then impairment loss was 200 based on the difference of 800 and 600 for allowance for impairment of trade receivables in the current year and the previous year. All right. Okay. So I'm just going to highlight the information that I've already utilized. So from the additional information, in fact, we've used all of them. And then from the table, we have used most of them as well. Okay. So now let's add all the expenses that we have got. Okay. All of this numbers. So let's start with 25,000. Okay. All right. So I'm just using the calculator on my laptop. So I'm going to be a bit slow. So 25,000 plus 21,000 plus 78,960 plus 8,600 plus 39,910 plus 200. So is it 173,670? Is that what you have all got? 173,670. That sounds correct. Okay, so let's just write that down. All right. So now that you have got the total of all expenses, you subtract this from the 229,800. Okay. All right. So 229,800 minus 173,670, which is 56,130. So the net profit or the profit for the year is 56,130. Oh, good. Okay. I believe that's correct. So 56,130. And this is to be utilized for the retained earnings calculation, the closing retained earnings, which we'll be doing eventually. All right. Okay. If you guys are ready, now we can move to the balance sheet, which is also known as the statement of financial position. Okay. So the balance sheet as of 31 July 2016. So the balance sheet is essentially us proving the accounting equation. And what's the accounting equation? If you recall, so the accounting equation is the total of all assets must equal the total of all equity and the total of all liabilities added together. All right. So this is essentially what we are proving when we are preparing the balance sheet, which is whether or not everything in our trial balance in our financial recording process are done properly. Okay, so we start with the non-current assets. Okay, and when we start with the non-current assets, we want to have three separate columns for cost, accumulated depreciation, and net book value. All right. So the two types of non-current assets that we have got are plant and machinery. So I'm just going to write plant plus machinery, and then we have got motor vehicles. Okay. Now the plant and machinery at cost was 193,000, not 196. Do you remember? We subtracted 3,000 that we had incorrectly recorded earlier. Okay. And then for motor vehicles, we have added 84,000 as the cost. Then for accumulated depreciation, for plant and machinery, it's 68,000 plus an additional 25,000 for the depreciation expense that we had incurred in the current year. Okay, which if you recall, we have seen when preparing the income statement here. All right. So altogether, 68,000 plus 25,000 is 93,000 in accumulated depreciation. And then for motor vehicles, it's 53,000 in accumulated depreciation, which is 32,000 plus 21,000. That's the number for the current year. Okay. So I'm going to highlight all this information that we have already selected. So I'm just putting a red tick next to it, which actually confirms the fact that we have utilized all this information so far. All right. Okay. So cost minus accumulated depreciation gives us the net book value, which is the third column that we want to calculate. So 193 minus 93 is 100,000. And then for motor vehicles, 84 minus 53 is 31,000. Okay. So let's find the total of the cost column, which is 193 plus 84, that's 277. For the accumulated depreciation column, which is 93 plus 53, 146. And the net book value column is 131,000. And we're not putting a balance sign here because we want to keep this column open, because this is the number that moving forward is going to be added with other information. All right. All right. So that takes care of all the non-current assets that we've got so far. Now let's do the current assets one. All right. Now the current assets, okay? We start with the general expenses that we had prepaid, right? So prepaid general expenses. We had included all this information explicitly when we were doing the workings. Do you remember? Okay. So we start with the prepaid general expenses of 350. Okay. And which means that general expenses is already done. And then we had interest receivable. If you remember, the total interest income that we expect to earn in this year is 1,500, right? Which is 10% of $50,000. But we have actually received 1,000, right? Sorry about that, 1,000, which means 500 is still left to be received. Okay? All right. So we have selected this. So interest receivable is 500. It's a current asset. Then we have got trade receivables. For trade receivables, we start with the original or the gross amount of 18,500 minus the allowance. Okay, so I don't have enough space here, but make sure in exam you write allowance for impairment of trade receivables, which is 800 in the current year, and that is 17,700 as the net trade receivables, which we are reporting. Okay, then so after the trade receivables are done, we have got the cash at bank, and always check if it's a debit or a credit. If it's a credit, it's an overdraft, which is a liability. But if it's a debit, it's obviously an asset. So cash at bank of 14,300. Then we have got inventory. Make sure to tick as you go so that you know what information you have already selected. So next we have got inventory of 36,320. Okay. Anything else? I think that's all of the current assets we have included. I believe so. All right. Okay. So let's add all these current assets and find the total for the total current assets. Okay. All right. So 350 plus 500 plus 17,700 plus 14,300 plus 36,320. So it's 200 and let me make a mistake. 1 second, please. So 17,700. Okay, so that's 80, 350, 500, 17,700, 14,300, 36,320. Okay, have we missed anything out? Nope, we haven't. Oh, we did actually. We did, which is a 10% bank deposit. Right, that was an investment on which the interest income or the interest receivable was calculated. So, yep. So make sure to add that as well. So we have got interest receivable. Okay. Interest. Sorry, banked. I'm sorry. It's the bank deposit. 10% bank deposit. Okay. So this was an investment, and that is 15,000. All right. Okay. I apologize. So you see there are many information that we have to include, and even I can make mistakes at times where we forget to add everything at the same time. All right. So let's add everything again. And when you add that, you should get 84,170 as the total current assets. Okay. So I'm just going to, so total current assets, 84,170. And what we're going to do is add the total of current assets with the total of non-current assets, okay? And whatever we get is the total assets. So 131,000 plus 84,170. So let's see. So 131,000 plus 84,170, which gives us total assets of 215,000 170. Okay, so this is the amount that we have to make sure is equal to the total of equity and liabilities added together. Okay, all right. Let's start with the equity and liabilities section. Okay, I'll try to make sure my handwriting is nice. So equity and liabilities. Starting with the equity. Okay, so for equity, we have got issued share capital. Okay, so issued share capital, which is $100,000. And then we need to find the closing retained earnings based on our discussion earlier. So the closing retained earnings at the end of the year is basically the retained earnings at 31 July 2016. And how do we find this amount? Okay. All right. So I'm just going to scroll back down and show you. So the closing retained earnings at 31 July 2016 is the opening retained earnings, which is 45,000. So you can see it here, 45,000 plus the profit for the year. You can check the information in the income statement. It was 56,130 minus the dividends that we declared, which is 12,000. Okay, and that gives us a closing retained earnings of 89,130. All good. All right, so 89,130. So that's it for all the equity that we have got. So we don't have any other equity. So we can just find the total of the issued share capital and the closing retained earnings, which is 189,130. And that is what we refer to as the total equity. Okay. So I'm just going to extend these columns. Pardon me for the messy table. But I think you get the idea of what's going on. All right. Current liabilities. So we will report all the liabilities now. So we don't have any non-current liabilities. In most cases, non-current liabilities will be any bank loan that you have taken, okay? Which in this question, we do not see any for sure. So therefore, we know that the only section for liabilities that we have got to prepare in this case is the current liabilities. So let's start with the current liabilities. Okay. So for the current liabilities from the table, the only information that's still missing to be used is trade payables, which we are just going to use now. So that is 13,480. Okay. Trade payables, 13,480. All right. Then from the additional information section, you've got general expenses of $560 accrued. Right? So accrued general expenses, 560. Do we have any other information? Yes, we've got the dividend payable from additional information number 6. Do you recall? The dividend payable that we calculated was $12,000. Okay, so that's it for all the liabilities that we have. So now we find the total current liabilities. So 13,480 plus 560, which is 13,980, 14,040 plus 12,000, which is 26,040. All right. So the total current liabilities is 26,040. All right. So now, what do we do now? So we add the total equity with the total current liabilities, since we don't have any non-current liabilities. And let's see, what do we get? Total equity and liabilities. So I've been writing plus instead of and because of the lack of space. All right, so 189,130 plus 26,040, which is 215,170, and that is a direct match with the total for assets that we have got. All right, which proves that our balance sheet is correct and we haven't missed any information because we also ticked every line that we have used as we solve through the question. Okay. All right. Okay. So I believe you found a lot of value in this content today. So make sure to like this video and subscribe to this channel. And let me know what other topics you would like me to cover. I'm going to be uploading videos on a daily basis anyway. So yeah, with that being said, I'll see you in the next lesson.